a huge part of this market needs to be saved if they're not Amazon and they're not Apple. And I love, love, love the phrase you've coined, the hope phase. What is the hope phase right now for investors and the huge body of people that don't own the high-flying techs?
Well, firstly, what is the hope phase? You know, if you look at history of bear markets and bull markets, virtually every bull market does start during a recession after a period of falling prices, when investors, for some reason, start to get more optimistic about the prospects for recovery. And that initial hope phase, the hope of recovery, tends to be reflected in quite explosive rises in stock prices, mainly driven by valuation expansion. And that's exactly what we've seen really since March. And I think it is consistent with this being the start of a new phase. What you say, though, is interesting, is that this new phase, this new cycle, is seeing the same leadership as we were seeing before, with the technology companies and the growth companies continuing to outperform significantly the old economy and the deep value parts of the market. But it's consistent with this ongoing shift to more negative real interest rates, and actually the disruption that we're seeing as a result of the technology companies changing the nature of many of these traditional businesses as the digital revolution continues. So I think strategically, we're in a new bull market phase. That's a good thing. But the secular trend is probably likely to be quite similar in terms of leadership.
Peter, you've made the argument, though, that Europe doesn't have to be left for dead here, that this is not just the United States big tech story, that Europe has a role in all of this. Can you walk us through that argument that you've been making over the last several months? Yeah.
Look, again, let's just look back for a moment. If we take the last cycle, the last decade or so, the period after the financial crisis, it was marked by very good returns in financial assets as rates came down. But the US was a massive outperformer of all equity markets. And the main reason for that, not the only one, the main reason was its exposure to the things that were doing very well, technology. Whereas Europe, of course, had a massive exposure to the areas of the market that were really at the epicenter of the crisis. You know, it had about a quarter of its index in banks, and another 10 or 15% in the oil sector, for example. Now, if you roll things on to where we are today, banks have fallen to about 6% of the index in Europe. Now you have technology being about twice the size of the oil sector. So while you don't have the same significant concentration of leaders in technology in Europe as you do have in the US, the market is becoming more growthy and it's becoming less value orientated. And what you have is a similar sort of style of concentration. You don't have the FANG stocks, of course, but you have what we've described as the granolas, the top 10 or 11 companies in Europe, that standing for the starting letter of each of their names. These are big companies which are cash generative, strong balance sheets in a combination of technology, healthcare, and staples. And that's really, again, what the market is paying for in an environment of otherwise weak growth and very, very low rates. And I think that probably will continue.